Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined again by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, July 6th, 2021. Glad to have you back, George.
Good to be here, John.
Well, let's start things off. I almost feel like a broken record starting with this, but before we get to discussing your views about the FOMC minutes and what to expect over the third quarter, what is going on with this latest move lower in rates? This rally is getting crazy. We rallied through 140 on, as far as I could tell, air today.
Yeah, it's been an unrelenting rally, and I feel like you said, it's definitely a broken record. And the topic du jour, every single time we get on this podcast, it feels like we get lower and lower rates. We're initially looking at the 160, the 150. Now we broke through the 140 on the 10-year. And I think just kind of looking at today in isolation and then thinking about why we've gotten such low levels in general. Today, I think, hard to explain everything away. It is, we did rally coming out of the NFP, even though it was a relatively strong jobs report on Friday, solid jobs report, and we still rallied. We couldn't muster to see rates higher then. There was, spillover, I think, activity into today's session, and what was happening, I think, also in Europe, and a general global rates rally was unfolding all throughout the day, and it was going to be difficult for treasuries to really diverge from this bigger move that's more global in nature, and partly kind of like linking back to just concerns about what's going on with the Delta variant of COVID and potentially issues going on in Europe as well as in the Middle East. So I think today was a very isolated case that just took us over the edge once again, like breaking through a key psychological handle, like 1.4 level on the 10-year, and now we're in the 135s at the time of recording. It's a pretty big move. I think in hindsight, as we look back over the last 2 months of having these conversations, what we've found and learned very clearly is that first off, long-term rates stopped rising once they got close, especially the 30-year. The 30-year stopped rising once we got close to 2.5%, which is the long-run dot for the Fed. And I think that that's still a pretty strong resistance to overall interest rates, and now in hindsight, it looks like a great buying opportunity. I think overall, as we've discussed in times before, I think the market's having second guesses about the sustainability of the recovery, which has been one of our views that although we don't, we're not calling for a recession, but we do think that growth is going to decelerate, and these are probably the best of times for this cycle in terms of actual growth numbers, but we're still going to be growing, but at a much more trend-like growth versus this, really quick growth. And if you think about just being short and the short base that was put in place in Q1, it took time to kind of work its way through it. And it looks like even with days like today, there's still some shorts out there that have to be covered. So I think, the positioning, the anchor for where long-term rates can get up to, as well as just carry costs and just doubts about the strength of the recovery, has led to this big move. I think going forward from here is going to be much more trickier. We had shifted lower our forecast when I initially launched our back in May, and my forecasts weren't not lower enough. We were not bullish, I guess, enough, I should say. And so I think at this point we've done a lot already, and I would expect to see some sort of consolidation. But these are impressive moves.
Yeah, I can't tell you the number of why are we rallying calls I fielded today, which is sort of points out that sort of underweight that you or short sort of shadow short base that you highlighted in your answer. Let's kind of move to something a little bit more macro. The Fed surprised the majority of us at the last FOMC meeting. That you and many others were expecting them to remain dovish for, as I recall, kind of one more meeting. And instead, the Fed came across as very hawkish, I would argue. So tomorrow, July 7th, so this will be actually for our listeners, just be like same day, when you're likely to listen to the podcast, we'll be getting the minutes from the June FOMC meeting where they made that hawkish pivot. What should our listeners be looking out for?
No, it was definitely a pivotal meeting. Which they in many ways, if you take a step back, the Fed became less dovish, and by pivoting that way, it felt very hawkish. but in the grand scheme of things, they're really getting back to neutral. But when you're 15 months of being ultra dovish with nonstop QE, the markets definitely got surprised, including myself. But having said that, I mean, the general pivot was going to happen at some point in 2021. They needed to start to kind of get the markets thinking about the tapering, not just talking about the tapering. And now, we're clearly focused on how will the Fed slowly get out of its QE buying of both mortgages and treasuries. I think tomorrow is probably still too early to get specifics on those sort of plans. I mean, again, they're just now putting it on the table. They're not really, I don't think, at the last meeting prepared to have discussed specifics. But we can start to think about what makes sense as a sequence of events over the next couple of months. I would be watching closely the intro paragraphs of developments in financial markets and open market operations. Also critically important, at the last meeting, they raised the RRP rate as well as the IOER rate by 5 bips. And I think we'll probably see a lot of discussion around why that was the case. And and since the meeting, the RRP facility got close to $1 trillion, and it's potentially earmarked to going much higher than that, considering that the Fed is still doing QE and there's this kind of shortage of collateral in the money market space, and so a lot of the cash is getting recirculated back onto the Fed's balance sheet. So I think any kind of discussions around the RRP are going to be super instrumental to be watching out for. And then on the taper, again, just what sort of brainstorming, if anything, was discussed on the topic is really what I want to be looking out for.
Gotcha. And speaking of taper, let's talk about that a little bit. Why don't you walk our listeners through the path of a potential tapering announcement as soon as the September FOMC meeting? And I'd be curious the risks to that scenario. It wasn't so long ago that people were thinking, it was like a December event. It looks like the Fed's brought that forward a little bit, and risks to the markets more generally.
No, 100%. So we are now at a point where a path could be made towards tapering if things line up. And what are those things? I mean, it's going to be a combination of both economic data, primarily further evidence that the jobs market is recovering at a strong pace, with Friday's number really, I think, being the baseline of what we should expect on a go-forward basis in order for the Fed to feel that they're green lighted to actually taper and that the economy is healthy enough on the jobs front. But as we look forward over the quarter, there are a number of other events and just kind of timelines that we should discuss. We do still think that the CPI reports are going to be important, although the NFP will be much more important. We have 3 CPI reports before the September FOMC meeting. We have 2 NFP reports before the September FOMC meeting, and we have a number of Fed events, both a non-quarterly Fed meeting where they will not give us updates on the interest rate forecast like the dots, but they'll still give us updates on where we stand as we get ready for the September meeting. So that's at the end of July, and we have the minutes of that, and we have a number of other kind of key events, notably the Jackson Hole at the end of August, which typically has become like a marquee event for policy innovation amongst the central bank community. So I think thinking through all this, as long as we see again the data hanging in there or performing well, I should say, and more like the stock market hanging in there and not seeing any sort of volatility or major declines, then the Fed could taper in September, especially if it decides to take a staggered tapering or a multi-stage kind of tapering where they could taper mortgages first and continue buying their treasuries at the same pace. And so I think that there's a couple different ways it can go about it. I think it's going to be predicated on this path being paved with the good data on the jobs front, stock market doing well and not having any major corrections, and the Fed would be tapering into a strong environment where they could address the mortgage part. The housing market is doing well, as we all know. So I think that's the easier scenario. It becomes more tricky if as we start to learn about the Fed's tapering plans, the markets start to get concerned and start pricing in some of those risk premiums back into mortgage bonds, back into credit if there's going to be some competition between the two asset classes, and even long-term rates going to start to head higher too, and make a U-turn from this big rally that we've had. So I think a lot of that's going to then drive what happens with overall financial conditions, and will the Fed still have conviction to taper in September if stocks are down like 5 or 10%? In my opinion, they wouldn't. So it really does come down to financial conditions, the jobs data being robust. And if they were to be delayed, then I think it would really be obviously the next port of call, which would be December, is when they could do something like that. If in the interim, while we're waiting for all this, if they were to skip September and go ahead with December, as long as, again, the economy is opening up and performing well, they can maybe even taper faster in December. So I think the starting point matters for both which asset class they're going to taper, and the overall kind of financial backdrop will drive when they make that decision.
Right, and is it the kind of thing, just to kind of a follow-up question there, where they do $5 billion a month mortgages, they start there, like something like that? Is that like what you're thinking?
Yeah, so I think what I've been saying even early on when I first joined, that this taper will not look the same in format as the first taper back in 2013, 2014, where they had a preset schedule with a certain amount that they were reducing both asset classes at the same time. I think that they are now afforded the luxury to kind of pick mortgages first if they really want to get this tapering process started, which I think, although the RRP is not the main reason to taper, there is obviously evidence that there's too much liquidity in the system. So tapering is going to happen one way or the other. Starting with mortgages is probably the easier route. I think $5 billion there, and then eventually doing a similar level in treasuries will give them a long runway into 2022 if that's the case. If the economy starts to kind of suffer some sort of hardships or slow down, they could also do what I'm thinking about, which is a kind of a two-stage treasury tapering, where they can slow down the tapering, actually stop the treasury part, and keep buying at a much lower level until we get better visibility on the outlook. I think the bottom line for me is that this taper will not be like the first taper that we got, and that they're not going to pre-commit to certain endpoints. They're going to keep it more open-ended, and that will give them flexibility to tackle things as they come.
Yeah, makes a lot of sense, trying to retain as much flexibility as they can. Well, George, I'm really glad we're making you a regular on the podcast. I'm looking forward to the next one to discuss your second half outlook. Thanks for joining us.
Thank you.
Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.